3 key takeaways. 1. Passing investment properties often triggers taxes. 2. The biggest risk is a liquidity crunch for your kids. 3. Plan early with pros and consider permanent life insurance to cover the bill. For many Canadian parents who invested diligently, the goal is a lasting legacy, security and stability for their children. Whether it's 1 property, 2, 4, or 10, that portfolio represents decades of effort and careful management. As you approach later years, the focus shifts from growth to succession and preservation. However, there's a significant hurdle: taxes that can surface when properties transfer to the next generation. In Canada, the CRA can treat transfers as a deemed disposition, taxes based on fair market value, even if no cash changes hands. This can surprise families who haven't planned, jeopardizing the very assets meant to protect them. Early on, investors focus on cash flow and acquisitions. Estate planning feels distant, but as time passes and values climb, your family's future tax exposure can balloon. This is a growing concern across Canada, not a niche problem. At the heart of it is capital gains tax, profit when an asset sells for more than you paid. When you gift a property or pass away, the CRA may treat it as if you sold at today's fair market value. Your estate calculates the gain as the difference between that value and your adjusted cost base. Currently, 50% of the gain is taxable and added to your final return at your marginal rate. Your principal residence may be exempt, but rentals, duplexes, and vacation homes are not. If your estate lacks cash to pay, your heirs may be forced to sell properties quickly. Instead of inheriting income, they inherit a sudden tax bill, undermining your legacy. Where real estate, taxes, and insurance intersect, planning can protect your family. Let's visualize the numbers so the stakes are crystal clear. 40 years ago, you bought a rental for $450,000. At 4% annual appreciation, that home could be worth about $2.1 million today. That's a $1.65 million capital gain. Half is taxable. $825,000 added to your final return. At a high marginal rate, that could mean roughly $412,500 in tax on 1 property. With 4 similar properties, the portfolio might be worth $8.4 million. That implies $6.6 million in gains, with $3.3 million taxable. The resulting tax bill could approach $1.65 million or more due in cash. Without liquidity, heirs might sell 1, 2, or even all properties to pay. A common solution: a permanent life insurance policy sized to the projected tax bill. Estimate the future tax, buy coverage for that amount, receive a tax-free payout at the right time. For couples, a joint last-to-die policy typically pays when the second spouse passes, when the big tax is due. The payout covers taxes so properties can transfer intact as intended. You turn a future unpredictable tax spike into manageable monthly or annual premiums. This isn't DIY. Work with a qualified accountant, an insurance advisor, and an estate lawyer. Your accountant sizes the tax, your advisor designs the policy, and your lawyer ensures the will and trust support a smooth transfer. Start early. The younger and healthier you are, the more affordable and flexible the options. Procrastination is costly. Automate what you can and review regularly. Protect your legacy. Speak with your accountant this month, explore insurance, and give your family peace of mind.